Are you striving to build deeper trust with your clients, ensuring every piece of financial guidance you offer is truly in their best interest? It is a question at the heart of ethical practice, and recent developments from the Department of Labor are designed to reinforce that very principle. The latest Department of Labor Fiduciary Rule changes largely reinstate and expand the investment advice fiduciary definition, particularly under the Employee Retirement Income Security Act of 1974, commonly known as ERISA. This means that more financial professionals providing retirement investment advice will be held to a stricter fiduciary standard. The core reason behind these updates is to protect individuals saving for retirement from conflicted advice. When you act as a fiduciary, you are legally and ethically obligated to put your client's financial interests ahead of your own. The DOL observed that many financial transactions, especially those involving rollovers from workplace retirement plans, were not consistently held to this standard. By clarifying and broadening the definition of an investment advice fiduciary, the DOL aims to ensure that advice given regarding these critical retirement assets is truly impartial and solely for the benefit of the client. For advisors, navigating these changes means meticulously reviewing your current practices and client interactions. This includes carefully documenting the rationale behind investment recommendations and understanding when your advice triggers fiduciary duties under ERISA. You will need to adhere to the impartial conduct standards, which requiring you to act in your client's best interest, charge only reasonable compensation, and make no misleading statements. Developing clear communication strategies for rollovers and other investment advice scenarios is also crucial. An important detail to understand is the reinstated Prohibited Transaction Exemption 2020, or PTE 2020. This exemption allows fiduciaries to receive certain compensation, like commissions, that would otherwise be prohibited, provided they adhere to strict conditions. These conditions include providing a written acknowledgement of fiduciary status, a written explanation of the reasons for recommendations, and meeting the impartial conduct standards. This is a key mechanism for ensuring advisors can still operate effectively while upholding a higher standard of care. Ultimately, these changes are about fostering greater transparency and accountability in the financial advisory landscape. By embracing these fiduciary principles, you are not just complying with regulations. You are actively strengthening client relationships, enhancing their trust, and providing a higher caliber of advice that truly prioritizes their long-term financial well-being.